The average Aussie makes a ton of mistakes when they purchase their first investment property or home, and so I'm sharing my 3 top tips to help you get into the market the right way and save a ton in tax along your investment journey. First, I want to start with understanding good and bad debt. Now, you may be familiar, if you've ever looked into debt recycling, with the idea that your investment property debt is tax deductible, whereas your home loan debt is not tax deductible. And a lot of people, when they've bought their first property, which is usually their home, they contribute towards their offset account for years and years until they've got enough money for a deposit on their first investment property. And then they take that money directly out of their offset account and use that as the deposit for their investment property purchase. And the problem with this is that this money is never actually being contributed to your home loan. Therefore, you can't claim a tax deduction for the potential interest on that portion of the money. If this individual had contributed that money formally and officially into their home loan and then redrawn that back out for the purchase of the investment property, then they would forever have that portion of interest on their home loan as a tax deductible expense. Secondly, the 6-year rule seems to have been gaining a bit of traction lately in the media. I hear a lot of clients come to me talking about it, but there seems to be a bit of a misunderstanding with how exactly it works. So if you're unfamiliar, the 6-year rule allows you to treat your former home as your principal place of residence for the tax exemption purposes for up to 6 years after you've actually left that property, which means you can move out, have that property leased out for up to 6 years, and then when you sell it, you can still claim it as your principal place of residence so that you pay absolutely no tax on it at all, with one caveat. If you actually move into another property during that period of time, you won't be able to claim that other property as your principal place of residence for that period, which means for the first 6 years, say for example, you've been living in your new home, you're actually paying tax on the capital gains of that property. A lot of people don't know this, a lot of people miss it, and it could mean thousands in taxes at the end of the year, and definitely something you should look out for. And the last thing that trips a lot of people up is understanding when the capital gains tax event occurs on the sale of your property. This is super relevant at the moment as we come into the end of the financial year, because what a lot of people don't realize is that the capital gains tax event on your investment property sale actually occurs when you sign the contract, not on the settlement date. Which means if you sign a contract on the midway through June, you could be up for tax for that portion of money on this financial year, not next. Which means you need to come up with that money a lot sooner.